Hey everybody, it's Dale here from theforexguy.com, and today I'm recording on the weekend because a unique opportunity has arisen for me to show you a basic concept of forex trading and where a lot of traders are getting it wrong, and funny things are happening with their orders and they're not understanding why, and I'm here to clear that up. It's all got to do with the spread. A lot of traders don't know how to factor the spread into their buy and sell orders. Okay, there's a bit of a rule to it, and if you don't understand the rule, then strange things are going to happen, and you might start blaming your broker, or getting frustrated. And you think there's someone's tampering with your account on the other end or something like that. I can probably guarantee you it's coming down to a misconception of your understanding with the spread and how your orders should be placed around it. That's going to be causing you these sort of like early trades getting stopped out early, or trades not getting triggered and things like that. So you got two prices on your chart. Okay, you have the bid price, which is what you see in the candlestick. So generally a charting software will just pump through the bid price and generate the candlesticks off that. Okay, most of us are probably using MT4, and that's exactly what's happening. So on MT4, you see the candlesticks, the high, low, open and close price. That's all quoted off the bid price, and the bid price is basically the true market price. It's, I guess, straight from the interbank market, pumped through straight to your chart, if that's a crude way of thinking about it. Then you've got a second price, which is where the trouble starts to come in, because you don't see it on your chart. It's invisible most of the time. Unless you force it to be on your chart, it's invisible. And that's the ask price. So the ask price is basically how your broker makes money off you. It's their quote, it's their price. So what happens is you will enter at the market at the bid price, and then you'll sort of exit at the ask price, or vice versa, depending on which way you're going. So when you're placing orders, you have to remember you're entering, exiting via two different prices. When you open a trade, you're in the negative straight away, and that's why, because you enter in at one price and you exit at the other, and obviously it's geared towards making sure that it's the broker that collects that spread profit. So the difference between the bid price, what you see on the screen, and the ask price is the spread. Okay, and you know this is how brokers make money, because that this is their business model. This is how they function. Every time you place a trade, they're going to be at a small advantage, because the ask price really is just a slightly worse price off than the actual true market price, and that's basically their little commission they're collecting. So how does this affect us when we're placing orders? I'll start off with my sell trade example here. So we've got a unique opportunity that's arisen, and it's going to allow me to sort of show you, what's happening here. Is because this is sort of an extreme example in play at the moment. So I have an order in play, and it's already been triggered, but the I was basically going in there with a retracement entry here on this rejection candle, and that means I would have had to set a sell limit. Okay, that's how you enter with retracement entries, a limit order, and my stop above the high. Now, the rule is, when you're selling, you use the bid price. When you're buying, you have to use the ask price. And yeah, so when you enter a short trade, you sell first, and then actually when you exit, you have to buy back to exit. That's kind of like how it works, right? So the rule of thumb for short trades is you enter at the bid price and you exit at the ask price, and that means your stop loss and your take profit, because they're your two exit points. Now, my sell limit was here, so there's nothing special I had to worry about, because remember, I enter at the bid price when I'm shorting, and that means as soon as the candlestick on the chart, or the price on the chart, touches my order, I should get triggered in. There should be no smoke and mirrors there going on. Where I have to actually take special consideration is in the stop loss and my target price. I don't have a target price set yet, but look at my stop loss. It's just up there. It's above the high of this rejection candle, sort of sitting up like that. There's a reason that I've done that, because the plan here is if the market breaks the high of this rejection candle, I want to get out. So why have I placed my stop loss, up above there like that? Because if the market, if the bid price came up, and what we see on the charts came up and reached the high of this candlestick, where would the ask price be? The ask price is going to be the what the spread is on top of the bid price. So let's just say my spread is 5 pips, for example, for this pair. So if that means the ask price is always going to be 5 more pips expensive than the bid price. So as soon as the ask price touches my stop loss, that's going to be the exit trigger there, because that's what the broker's using to quote for your exit price there. So let's just say I've placed my stop at 5 pips above there. That's why there's that gap. Okay, so if in the case the market price does come up and reach right up on the highs there, I don't want to get stopped out until it goes, let's say, 1 pip over the high of this rejection candle here. One. So that high point there, let's just say I want to stay in the trade as long as the market stays, within or equal to the high of this rejection candle. Then I'll need to take the high of that rejection candle and then add another 5 pips and put my stop there. I've probably added a little bit more than 5 because I generally do that just for the sake of spread fluctuations. So remember, any fluctuations in the spread are going to fluctuate the ask price, which we're going to show you in a second. So that's why I have my stop loss up there like that. Now, this is where traders go wrong. If you say, okay, I want to exit when price touches the high of the rejection candle, or the high of the previous candle, or whatever. If I put my stop loss right there, guess what? If the market doesn't have to come up and touch the high before that stop loss gets triggered, it will get stopped out much earlier than that. Price only has to reach within, let's just say remember, keep in mind, we're using the 5 pip spread example, but your broker could be different. But here, if the spread is 5 pips, the market only has to track up within 5 pips of where your stop loss is, which could be about here, and that's going to trigger your stop loss. And to you'll think, okay, my stop loss got triggered early, but it didn't. It got triggered when it was meant to, because you're exiting at the ask price here, and basically, the ask price did touch it, but you don't see that. You're only seeing the bid price on the chart, most of the time. So you have to anticipate where the ask price will be to place these stop losses correctly. Now there is a way to get your ask price on the screen here for MetaTrader. It's pretty simple. Just go to the chart properties, and there's a little option there which is not normally ticked. You can select that ask price, and as soon as I press OK, you're going to see another line pop up, and that's where the ask price is currently. Okay, so there it is. So that's a huge gap, and the reason there's a huge gap here is because of this weekend spread widening. I think liquidity just dries up, extremely, a couple of ticks before the market closes. So just within a few ticks, on the Friday close, spread starts to, bubble up. It's quite common. But here's where my trade. Here is where my. What's another way to put this? Oh, okay. From my entry point, I'm up. I should be up 60 pips in profit. But when I look down at my trade, I'm thinking it's only up $300. What the hell's going on? I should be up a lot more than that. I'm not really kind of up that much. Because short positions exit at the ask price. So if I was to close that trade right now, if I could do that, it's the weekend right now, the market's closed. But if I could close this trade right now, it's going to exit at this price. That's all I'm going to get. So I'm only going to get, 20 or so pips, if that. instead of this, what you would expect to exit out there. So, this is where you've really got to get this around your head, because it's important, and it also affects your take profit levels when you're selling as well. Because remember, when you're selling and you want to exit the trade, you have to exit at the ask price, because you need to buy back. So you sell first, which means you enter at the bid price. Then any exit point is the ask price. Now let's just say this line. Let's just say that this level I've got here, that's my take profit point. Let's say that's where I want to take profit. I wouldn't just go and place my take profit right on that line, because the market could track down and touch that level to the pip and bounce off it, and you'll think, oh wow, I nailed my entry point down to the pip. But guess what? You won't actually get filled there. Your trade will still be open. It won't exit there. Why? Because the ask price would not have touched that. For the ask price to touch that, price would have to go below that level within, let's say the 5 pip spread example again. Would have to go below the take profit level 5 pips before the ask price comes down and catches up. Because remember, when the market's down here, the ask price is 5 pips more expensive, more above it, so the ask price would come down and touch it. So I don't know if you've ever noticed, but sometimes you'll have your take profit level there, and you'll see price below it, and you'll think, what's going on? Damn, just get out already, Especially, I guess, you guys who are into scalping and stuff like that. You're on these really low time frames, and you'll see it like you're more zoomed in. You've got a like more focused sort of scale on the chart, and you'll see this probably happening a lot more. You'll see the actual bid price going below your take profit, and you think, damn, the price has hit it. Why isn't it getting out? But it's because the ask price hasn't hit it yet, and you need the ask price to hit your exit points on your short trades for it to trigger. So when you're short, the order does not care about where the bid price is at. It's looking for the ask price to touch it. And you can see here, like, here's the bid right now. Okay, this is where the bid is. This is the market price right now, and this is the ask price. So you can see I've got a very, very expensive ask price right now, because I've got a 36 pip gap there. As soon as the market opens, that the spread's going to tighten back up, and the ask price is just going to shoot back down. I guess within 5 pips there. So the ask price will probably be there. And that's going to drive my trade profit, right back up, because, that's going to be my floating exit point for well, when you see the profit on a short trade, it's just quoting you the ask price, right? If you just exited there, it's just, quoting you the ask price profit of your trade. So with that in mind, let me just quickly give you an example of a bullish scenario, which is kind of the same thing, but it's reversed. You only have to worry about your entry point. So when you're buying or entering long, you only have to basically worry about your entry, because you enter at the ask price. So again, you've got to factor the spread into that, because there are circumstances where traders may see price touch their buy order and not trigger them in. And it's just the same principle. It's because the ask price has not touched that level. So let's just say, hypothetically, this entry line here, that's where I want to get in. So when price touches that entry line, and that's when I say price, I mean what I visually see on the candlestick chart. When I see that price touch the entry line, I want to get in. Now, if I place my buy limit order right there, price can come down on the chart price can come down, touch it to the pip and bounce, or maybe even dip 1 or 2 points below and then bounce, and you're not going to be in that trade. You'll be left, the train will leave the station without you, because the ask price never came down far enough to touch it. So you have to let's say if you want to enter here, you'd have to anticipate where the ask price will be when the bid price, when what the candlesticks that you see on the chart touch this level. Where's the ask price going to be? Well, it's going to be, if the spread's 5 pips, it's going to be 5 pips above this level. I know my illustrations are a little bit of a, exaggerated, but I'm just trying to, illustrate the point. That's probably like, I don't know, 10 or 15 pips there, maybe even more. But when the candlestick touches the entry point, where's the ask price going to be? It's going to be the spread plus whatever the spread is above, the current price. So it doesn't matter whether your spread is 10 pips, 5 pips, 0.1 of a pip. It has to be factored in. So in this case, if I've got the 5 pip spread example, the market will come down and test the entry point where I want to get in, and the trade will get, and this is where my actual buy limit order is placed. Okay, it will get triggered in because when the market price reaches here, it will push the ask price back down here as well. The ask price will drag down and track and always float, that 5 pips above it or whatever the spread is, and get you triggered in. So that's basically, it's the same with the buy stop as well. So if you want to take a breakout trade, you can actually get triggered in too early, because let's say I want to take the break of this high here, the market can basically come up, and then maybe about here, when you see the candlestick price here, all of a sudden it triggers in. What the hell? That's because the ask price is 5 pips above, and the ask price touch your entry order, and it's triggered you in. It's done exactly what it's supposed to and entered you in. So really, you need to place your breakout orders, the spread above the area you want. If you're waiting for a break of this level, then your actual buy stop order would need to be placed above here somewhere. So this, again, it's an extreme example, but if the spread was 5 pips, you would say, okay, I want to take a trade when price breaks this high. Then you'll need to get, at least put your buy stop order 5 pips above that high, and have it there. You need that gap there. And I usually actually put just that little bit extra on, because any spread fluctuations will affect it as well. You still can get triggered in early, even if you say 5 pips. If the spread's 5 pips, okay, I'll put it exactly 5 pips above the high there, and all of a sudden there's a news release, and the spread starts going crazy. It can drive the ask price up higher and trigger you in, even if the price is like down here or something like that. So be careful when you're placing your entry point for your long trades. You must factor in the spread, otherwise you're going to get triggered in too early or not get triggered in at all, depending if you're using a stop or limit order. It's very simple when you're exiting long positions, because you exit at the bid price. So if I just want to exit at this 1 to 4 risk reward, then I can put my exit price there, and as soon as the candlestick touches it, it should exit straight away. But just to be safe, I usually just, if there's a technical level or something that I'm looking for, resistance or something to exit at, then I'll just go a little bit below. I find it's a little bit safer. So hopefully that clears things up. It's one of those things that many traders don't understand and get frustrated with. I get a lot of questions about it, and I wrote an article a few years ago about it, trying to clear this up. So I'm just making this video to kind of supplement that article, and hopefully this visual demonstration clears things up, and in the future you're not going to get caught out by the ask price, like this. All right, guys, if you want any more tips, or check out any of my other articles and that, just come over to theforexguy.com. And you guys have a good weekend, and best of luck on the charts for next week.